Gordon Brown in dire warning about the next financial crisis. The world is not ready to deal with another financial crisis, former Prime Minister Gordon Brown has told the BBC. A breakdown in international cooperation means nations would be unable to act in a concerted way to tackle future threats, which are many. "I feel we're sleepwalking into the next crisis," said Mr. Brown, speaking on the 10th anniversary of the start of the previous crisis. He added that some of the bankers involved should have gone to jail. Mr. Brown, speaking from his living room, said, "This is a leaderless world, and I think when the next crisis comes, and there will be a future crisis, we'll find that we neither have the fiscal or monetary room for maneuver, or the willingness to take that action. But perhaps most worrying of all, we will not have the international cooperation necessary to get us out of a worldwide crisis." In the immediate aftermath of the collapse of Wall Street banking giant Lehman Brothers, the UK government was one of the first to press the case for using public money to recapitalize failing banks, and did exactly that, pumping taxpayer funds into Lloyds, HBOS, and RBS. Mr. Brown, UK Prime Minister, as the crisis unfolded, said that it was possible to counteract the evaporation of trust in the markets by coordinated action between governments and regulators that trusted each other. But now with the trade wars, the disagreements over climate change, the nuclear deals that have fallen apart, there is no spirit of cooperation. There is division and protectionism, and I fear a new crisis would see nations trying to shift the blame to each other. He acknowledged that the use of public money to bail out high-earning bankers was a difficult pill for the public to swallow, and although he insists it was necessary, he says that he is frustrated that harsher penalties weren't dished out to some of the bankers involved. "I'll be honest with you. Some of these bankers should have gone to jail, and until we have proper laws that can find the guilty and show there are clear penalties, then people will think the bankers have got away with it and will go back to doing the same thing again." What blame does he bear himself? Former Governor of the Bank of England, Mervyn King, has been critical of the way his government designed the regulatory regime, moving bank supervision away from the central bank to the Financial Services Authority. Mr. Brown acknowledges that it didn't work perfectly, but argues that the system was designed to look at isolated outbreaks of bank distress, not a contagion which consumed the entire global financial system. No national warning system, he says, was equipped to see the full picture, and no individual country could have tackled the meltdown. A global problem needs global cooperation. Without that, and with most of the tools available already used, rock-bottom interest rates, trillions pumped into the system through quantitative easing, Mr. Brown paints a grim picture of our ability to face the next crisis. Will central bank policies set off another global financial crisis? The financial crisis that started more than a decade ago still reverberates through the United States and the world. During the crisis, central bankers gained more powers, which they used to stabilize the financial system. But in doing so they have triggered other unintended consequences. A new book looks at just how much influence central bankers have gained since the meltdown, and what it has meant not just for the big banks, but also for small and medium-sized businesses, individuals, and the economy in general. Collusion: How Central Bankers Rigged the World is a book by Nomi Pritens, a former banker with Goldman Sachs and Bear Stearns, who is critical of the Fed and other central banks. She takes them to task for how she believes they mishandled the 2008 crisis. 3 years ago, Prince was invited to address a joint meeting of the Federal Reserve, the International Monetary Fund, and the World Bank, after characterizing central bank policies as insane. She contacted the Fed to ask if the invitation was a mistake. They replied, "We're looking forward to hearing what you have to say." Knowledge at Wharton: This has been an important topic for you over the last decade or so. How do you believe central bankers made mistakes and set us up for the next fall? Nomi Pritens: You mentioned the conference that the Federal Reserve, IMF, and World Bank have every year in Washington, D.C., where they invite other central bankers from around the world. At the time, the topic that is relevant to your question was, how come Wall Street isn't helping Main Street? That was the topic they chose, not me. The idea was that we have offered so much help to the financial system and to financial assets and markets around the world. How come this isn't trickling down into the real economy? How come it is not instilling sustainable growth figures? That's one of the main concepts within the book. There has been up to $22 trillion worth of subsidization for the financial system, for banks, for the markets, and that has materially produced sustainable growth. Yes, we had in the last quarter in the U.S. growth of more than 4.1%, but that was largely due to the soybean sector, as well as a lot of debt that has been amassed by consumers, which is now nearing another record high. The Federal Reserve is supposed to be watching for crises that are building, not ignoring them. But over the last 10 years, despite this conjuring of quantitative easing, low rates, and easy money policy, by the major central banks in particular, there has been relatively little sustainable growth. Certainly not more than 2% for any 1 year in any major economy in the last 10 years. Certainly not with respect to wages. There has been growth in debt, there has been growth in stock markets, and there has been growth in the health of banks, because they receive this money. But it has not necessarily been in a sustainable manner for the true productive economy. Knowledge at Wharton, that theme comes through in every part of the book, because the chapters are broken down by country. You talk about Mexico, Brazil, China, Europe, Japan. You call the central banks money conjurers, and say the results are economies that look healthy on the surface, but the foundation underneath is rotting. Can you talk more about that? Prince, we see that from some of the volatility in the market. We see that from looking into some of those countries that I go through in the book. I call them pivot countries because some are more on the emerging market side, and some are part of the G7. And some, like China, have entered the superpower status from an economic and geopolitical perspective in these last 10 years, as a result of how some of this money was conjured by their central bank, as well as the other major G7 central banks. The fact is that there is a direct correlation and causation, so there is a straight line between the amount of quantitative easing or asset buying that was conducted. I use the term collusion as the title of the book because the Feds required or sort of colluded with some of the other major G7 banks to keep this policy going globally relative to the stock markets in these individual countries. And the money that was manufactured or conjured largely went into purchasing different kinds of asset or debt in the different areas, depending on what the needs were. For example, in the United States, the Fed, at its height, conjured $4.5 trillion in order to purchase two things. One is U.S. government debt, from the banks, because they are the major brokers of that government debt in general. So, the Fed provided them money in return for those bonds to come from the Treasury Department to the banks and back to the Fed. The other thing is $1.75 trillion as part of that $4.5 trillion of buying mortgage-related assets. Mortgages were at the crux of the financial crisis 10 years ago, as were manifestations of mortgages throughout various kinds of engineering of the banks that were involved. As a result, banks were able to receive money in return for effectively rotting assets. And as a result of that, those assets could be valued higher than they actually should have been, because you have the source, the Fed, buying them. You have demand, you have a source. Therefore, other assets, besides the ones that are bought at a higher level, and they should be, also get to be marked higher. There was a lot of finagling from that perspective. Taking that globally, quantitative easing in Japan looked like purchasing exchange-traded funds, ETFs. More money was going into the stock of companies that the Bank of Japan and the Japanese government deemed worthy, which were generally the bigger companies in the country. Within Europe, the European Central Bank did the same thing, and predominantly bought government debt as well as corporate bonds of the bigger companies they deemed worthy of having that subsidy. What that resulted in was more inequality from the standpoint of corporate debt, emerging market versus developed country debt, stock markets being propelled higher because of money going into them, and, as a result of money being rendered so cheap, the interest payments on debt being so low and government securities being so low that stocks were the best place to invest. They continue to be the best place, because this policy actually continues, and that propelled a bubble in the stock markets throughout those nations. Knowledge at Wharton, right now, the U.S. economy is doing great by virtually any yardstick. Unemployment is near a 2-decade low. The stock market is strong, and has been setting records recently. Corporate profits are at record highs. But a report from the Urban Institute finds that almost half of Americans are having trouble paying for basic needs such as food and housing. Are those underlying problems part of what you're trying to highlight in the book? Prince, that's right. That unevenness, That inequality economically, financially, asset-wise, is pervasive. The household debt in the country is extremely high. It was at the same level in the last quarter relative to how it had been before the financial crisis hit. Except then, household debt had a bit more of a weighting towards actual homes. Now it has more credit card debt, auto loan debt, student loan debt, and so forth. Citizens are having to borrow to meet those costs. And when you re-borrowing to meet those costs, it has temporary borrowing. That temporary borrowing could extend for a while, but the reality is that it is requiring extra money to come in to make ends meet. The central bankers don't have a true exit plan, because it means that markets would implode. At the top end, about 10% of Americans own 85% of the stock market. So, the participation rate in what has increased the most over these 10 years stock levels is actually quite low throughout the country. The companies that have been able to borrow cheaply and purchase their own stock, for example, or to buy back their own shares in record amounts, look better. They've had the benefit of cheaper money coming in because rates have been so low, and the benefit of being able to utilize that money into their own shares, which propels their shares up, which makes them look better, which makes their participation in GDP look better. However, all of those people who are not involved in the stock market, as well as those people who are borrowing and living paycheck to paycheck, whose benefits aren't as secure, are the ones struggling. This is a situation that exists in many countries throughout the world because of the outpouring of money that central banks have created and brought into only a fraction of the markets and of people and of companies. It is also in the relationship between emerging market countries and the developed countries. What has made that relationship more unequal is that money has gone zooming out to find places to invest. Because with rates low, investors go into the stock market, into emerging markets, into riskier corporates, and so forth to find that return. Emerging markets have been a recipient of this over the last 10 years. But the downside of being a recipient is that money goes out, too. Knowledge at Wharton, that's the so-called hot money, right? Prince, that's exactly right, it is literally hot. You take your hands off it because you will burn them, and you do that quickly. That's what happens with speculative capital. Knowledge at Wharton, how do you view the actions taken at that time by then Fed Chairman Ben Bernanke and Mario Draghi, President of the European Central Bank? Prince, that was where the collusion happened. If we go back 10 years ago, the Fed did not have enough wherewithal, because the financial crisis in the banking community was so much worse than was even recorded, to simply plug those gaps and help just the US banks and leave it alone. It required other major central banks to collude, to work together in order to precipitate the same quantitative easing and cheap money atmosphere throughout the world. In some of the earlier statements he was making in Congress and so forth, Bernanke tried very quickly to move away from the cause of the financial crisis being the U.S. financial system, over which the Federal Reserve is supposed to have regulatory authority. It is supposed to be watching for crises that are building, not sort of ignoring them. He tried to very quickly push the idea that there was a global crisis that was somehow independent of the financial crisis that had been caused predominantly by U.S. banks. Why was it caused by U.S. banks? Because they were the ones who largely manufactured the mortgage-related or toxic assets leading up to the financial crisis. They produced them in the highest quantity, and they distributed and sold them throughout the world in the highest quantity. They lent money to buyers, to communities, to municipalities, and so forth throughout the world in order to buy and continue to buy these assets as they were deteriorating. They caused the financial crisis. Bernanke tried to walk that back and say, well, maybe we did, but we fixed it. And look at Mexico. They re-hemorrhaging. Do you know, China is not doing great things. He tried to defuse the role that the Fed had played. The only way he could do that monetarily, beneath those speeches, was to require the rest of the central banking community to produce or conjure record amounts of money as well. That kept the cost of money globally, which it still is, at about 0%. Even now, with the Fed raising rates, they still have a situation where the European central banks have negative rates and the Bank of Japan has negative rates. Net, nothing has changed in the world. They are still propelling the same policy forward on a global basis. Quantitative easing has globally continued to rise. Knowledge at Wharton, there are two other important points you make in the book. One is that banks were given all that money but failed to provide loans to small and medium-sized businesses that helped the economy. Second, keeping interest rates so low hurt retirees and pensioners who depend on interest rates to fund their retirement. That's partly why there's a looming $4.4 trillion shortfall in the public pension systems. That $4.4 trillion is just the national figure. If you expand that globally, all our economies and markets are interconnected, so it becomes significantly higher. The result was pension funds or long-term life insurance type of investments trying to compete with cheap money when they used to invest in government bonds that had higher rates and were more secure than corporate bonds. There's more risk in terms of any individual corporation or the stock market. Yes, the stock market has gone higher over these years. That's because a lot of money has been artificially created, which has enabled it to continue to go higher. Because of both of those factors, the rates that retirees were used to getting aren't there anymore. As a result, a lot of these pension funds and so forth have had to increase their holdings in the stock market, which is another reason why it is higher in order to even keep up with these shortfalls, instead of doing it in a more secure manner that was more historic and legacy to pension funds. That's a problem because not only is that also a ticking time bomb, but what if the markets to go down? What if there is a reversal of policy? Rates are still zero throughout the world. The central bankers don't have a true exit plan, because it means that markets would implode, and that would be another source of real pain for pensioners. Net, nothing has changed in the world. Knowledge at Wharton, you talk about the high risk of another major financial crisis, which will be difficult to recover from because we haven't fully recovered from this one. What could trigger it? What can be done to prevent it? When I was asked this question a number of years ago, I used to somewhat believe some of the leaders of these central banks, who were saying they will stop quantitative easing, that we'll gradually shift into something else. Mario Draghi was famous for saying, "We're going to stop this policy," in the middle of 2016. No, we're going to stop in 2017. We're reducing the amount of purchasing we're doing each month, but we're extending the lengths of months through which we're purchasing. There were all these bits of illusions that boiled down to, we're going to continue doing what we're doing, because we have no choice. Quantitative easing has globally continued to rise. It was down a little bit last month. But for the most part, even as the Fed had stopped purchasing assets, the rest of the major central banks have increased their purchasing. Now, there is a higher global quantitative easing and a same average interest rate that continues to propel the illusion to an extent of health economically. The reality of financial assets, like the stock market, continuing to reach new heights, particularly in the U.S. That's where these wrinkles are going to start to show in a more pronounced way. There are problems, for example, in Turkey, Argentina, in the Latin American emerging markets. And all of these problems start to create wrinkles or splinters. When does that stop? It's a situation, like in any liquidity crisis, where money starts to be afraid of going places. It starts to return to home base. We're seeing that with respect to money coming out of emerging markets and into the U.S. that becomes real money for the economies. For speculators, it's just moving stuff around. But when it starts to come out of stock markets in order to make up for the shortfalls that now corporations might show or pensioners might need, it starts to deflate. The Fed is talking about raising rates and selling some of their assets, which they've done slowly, because they know the reality is that if you sell too many assets off of the Fed's book, bonds start to deflate. That starts to cause money to come out of the stock market. So, they're being very careful. As a result, it won't look like a crisis for a while. Jack Bogle reveals the biggest risk of the next financial crisis and why he's still investing. This week marks the 10th anniversary of the collapse of Lehman Brothers and the start of the Great Recession. And some experts say that another financial crisis is inevitable. As legendary investor Jack Bogle told CNBC's Power Lunch on Wednesday, there are always blind spots, or, as I have said, the fog of the stock market. Nobody really knows what's going on. Thanks to the 2008 crisis, there are risks that we know, the founder of the Vanguard Group added, but there are risks that we don't know even exist. And that's the problem. Every crisis is different. Every bear market is different. Still, while there are a lot of signs of exposure in the market, Bogle said, that's not stopping him from investing. Nothing right now would cause me to get out of a long-term investment program, and certainly nothing would stop me from continuing to put away my $100 or $200 of $500 every month in my 401k or my IRA. That's because buying and holding for the long term tends to be an effective investing strategy, no matter the economic climate. As Bogle told CNBC, if you hold the stock market, you will grow with America. Warren Buffett agrees. No matter what the headlines say, American business is going to do fine over time, the Oracle of Omaha told Judy Woodruff of PBS NewsHour in 2017. Occasionally we go off the tracks with bubbles, but it will never permanently derail us. In fact, when he bought his first stock in 1942, the headlines didn't look good, he noted. We were losing the war in the Pacific. Markets go up and down every day, but that doesn't necessarily mean there's significance to every move. As an investor, it helps to be patient and to accept a certain level of uncertainty. Since buying his first stock, decades have gone by, and in all those years, I've never known what the market is going to do the next day, Buffett said. That's not my game. My game is to decide whether I'm in the right economy, which America has definitely been ever since that time. Here's what could cause the next financial crisis. 10 years after the financial crisis, experts are looking ahead to potential systemic risks that could lead to another economic collapse. A new report by the Depository Trust and Clearing Corp. DTCC, released this week, detailed a number of risks to financial stability, citing cybersecurity as potentially the most important near-term threat. Researchers say that although cyber-related threats are not new, they have grown exponentially and undoubtedly pose a much more serious risk now than they did a decade ago. The DTCC said, the most alarming evolution among cyber thieves is the transition from crimes motivated by monetary gains to those developed by state-sponsored actors and focused on geopolitical disruption, including disrupting critical infrastructure. That means cyber attacks focused on financial institutions, which have become more frequent, have the potential for far-reaching, systemic impacts. Experts have put cyber threats at the top of their risk list since 2013, and this year, the DTCC concluded that it's a matter of when, not if, regarding the likelihood of a successful widespread attack. In June, the International Monetary Fund, IMF, released a report that estimated financial institutions stand to lose $200 billion per year from cyber attacks, eroding profitability and threatening stability. The IMF noted that the financial sector is particularly attractive to cyber attacks, and the interconnectedness of the system would allow the impact to spread. In addition to cyber risks, the DTCC cited market-related risks, including the rise in popularity of exchange-traded funds, ETFs, which drums up liquidity concerns, and increased contagion risk. International trade relations were cited as a macroeconomic risk, as well as global debt. Morgan has a date for next financial crisis, warns investors for 2020. Morgan's Marko Kolanovic has previously concluded that the big shift away from actively managed investing has escalated the danger of market disruptions. How bad will the next crisis be? Morgan Chase & Company has an idea. A decade after the collapse of Lehman Brothers sparked a plunge in markets and a raft of emergency measures, strategists at the bank have created a model aimed at gauging the timing and severity of the next financial crisis. And they reckon investors should pencil it in for 2020. The good news is, the next one will probably generate a somewhat less painful hit than past episodes, according to their analysis. The bad news: diminished financial market liquidity since the 2008 implosion is a wild card. The Morgan model calculates outcomes based on the length of the economic expansion, the potential duration of the next recession, the degree of leverage, asset price valuations, and the level of deregulation and financial innovation before the crisis. Assuming an average-length recession, the model came up with the following peak-to-trough performance estimates for different asset classes in the next crisis, according to the note. A U.S. stock slide of about 20%. A jump in U.S. corporate bond yield premiums of about 1.15 percentage points. A 35% tumble in energy prices, and 29% slump in base metals. A 2.79 percentage point widening in spreads on emerging nation government debt, a 48% slide in emerging market stocks, and a 14.4% drop in emerging currencies. Across assets, these projections look tame relative to what the GFC delivered, and probably unalarming relative to the recession/crisis averages of the past, Morgan strategists John Normand and Federico Manicardi wrote, noting that during the recession and ensuing global financial crisis the S&P 500 fell 54% from its peak. We would nudge them all at least to their historical norms due to the wildcards from structurally less liquid markets. Morgan's Marco Kalanovic has previously concluded that the big shift away from actively managed investing through the rise of index funds, exchange-traded funds, and quantitative-based trading strategies has escalated the danger of market disruptions. His colleagues wrote in a separate note on Monday of the potential for a future great liquidity crisis, the shift from active to passive asset management, and specifically the decline of active value investors, reduces the ability of the market to prevent and recover from large drawdowns, Joyce Cheng and Jan Loeys wrote in the note.